Let's face it, every investor hopes for investments that effortlessly generate income, paving the way to financial freedom. We're aiming for hassle-free investments where the money grows on its own. However, among various strategies, only one has stood the test of time: investing in dividend stocks. But the crucial question remains: which dividend stocks are the right choice? Can they genuinely offer financial security no matter your experience level? We all seek advice, and who better to guide us than the respected Oracle of Omaha? He recommends buying stocks today, tomorrow, next week, or next month.
Recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically to hold them the same way you would hold a farm and never look at a quote. You don't need to pay attention to them.
Today, we're following Warren Buffett's lead to reveal the top 7 dividend stocks to buy and hold forever. We'll explain why they are essential for your investments, how they provide a steady income, and their potential for significant wealth growth. Are you prepared to take a big step towards securing your financial future? Warren Buffett is a well-known figure, often called the Oracle of Omaha. His reputation in the investment world speaks for itself. He openly shares his knowledge, strategies, and expertise in choosing stocks that create value.
I think every business should be run as efficiently as possible, and some are and some aren't. We try to buy the ones that are.
His experience, gained through great success, stresses the importance of lasting value rather than quick profits. He looks for companies with strong basics and competitive edges, focusing on their ability to maintain and grow dividends in the long run. For him, a decent dividend from a stable company is better than a high dividend from an unreliable one. Patience is key, and Buffett excels at it. Let's get straight to it and reveal the 7 top choices for your investment portfolio. If you're interested in tech stocks offering higher than average returns, why haven't you considered investing in HP yet? We all know Buffett rarely invests in tech stocks, correct? But consider this: Berkshire Hathaway has made a noteworthy exception by holding a substantial 12.3% stake in HP, among its largest holdings. In early 2022, HP's prospects caught Buffett's attention, leading Berkshire to acquire a remarkable 121 million shares in the tech company. This move created quite a buzz, causing HP's stock price to surge by a rapid 15%. What's remarkable about HP is its impressive track record of consistently increasing dividends for 13 years straight, boasting a healthy dividend yield of 3.5%. Despite recent revenue challenges, its dividend payouts remain strong. Firstly, the management maintains a balanced debt-to-profit ratio for a healthy financial position. Secondly, they actively cut expenses to ensure ample cash flow for growth and dividends. Moreover, HP strategically invests in long-term potential areas like remote work solutions and subscription-based printing services. As the economy improves, HP's printing and consumer PC businesses are expected to recover. With a forward PE ratio of only 9, it's clear why Berkshire Hathaway sees potential in it.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
Rarely does Warren Buffett express regret over a financial decision, but he certainly did so regarding the 6th stock on our list. While many income-focused investors pursue high-yield dividend stocks, they often overlook a crucial principle: appearances can be deceiving. Consistent earnings, ample cash reserves, and liquidity are essential for steady dividend payouts. Additionally, a stock's ability to consistently yield strong returns over time, combining both growth and dividends, is crucial. That's where JP Morgan Chase shines. It excels in all these aspects. The Zacks consensus estimate for JP Morgan's earnings reflect positive revisions, signaling optimism for its future. In fact, did you know that JPM currently holds a strong buy rank based on its performance? Its shares surged by more than 15% this year, significantly outperforming industry growth. Moreover, JP Morgan has achieved an impressive 12.5% earnings growth in the past 3 to 5 years, surpassing the industry average of 6.1%. What's exciting is that this upward trend is expected to continue, with projected earnings growth at 24.8% in 2023. JP Morgan has strategically expanded its reach through domestic and international acquisitions, diversifying its revenue streams. After passing the 2023 stress test, the company plans to increase its dividend by 5% to $1.05 per share, alongside a share repurchase program. These factors make JP Morgan Chase an excellent choice for investors seeking a dividend stock for long-term holdings, offering consistent performance regardless of market conditions.
Their businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they'll turn out to be the best investments at all.
Let's move on to the fifth dividend stock on our list, Occidental Petroleum, commonly known as OXY, a company that has been attracting attention in the market. Its remarkable 91% stock surge over the past year is not the sole reason for its popularity. Just a few months back, Berkshire Hathaway's stake in Occidental crossed 20% during Russia's invasion of Ukraine. By March, this stake had increased to approximately 23.6%, equivalent to about 211.7 million shares, valued at around $13 billion. But have you ever wondered what makes Occidental so special to warrant such a substantial investment? Firstly, Occidental stands out in technology, with highly efficient drilling methods. It also remarkably held around 23% of the most successful wells during the Anadarko acquisition, despite having fewer than 5% of the total Permian Basin wells. Moreover, Occidental shows promising future potential with its dedication to investing in low-carbon technologies. While it may seem inexpensive with a low PE ratio presently, it's important to note that Buffett's investment strategy of long-term holdings aligns well with Occidental's extensive project inventory and high-efficiency technology. With its appeal spanning the present, near future, and far-reaching prospects, it's no wonder it has become a significant part of Berkshire Hathaway's investment portfolio. At the fourth spot, we highlight the United Parcel Service, recognized as a significant economic indicator for valid reasons. This global powerhouse in package delivery, shipping, and logistics plays a crucial role across multiple industries. Let's delve into why investing in UPS stock is appealing right now. As the world's largest courier company, it amassed over $100.3 billion in revenue in 2022, with 78% originating within the country. One compelling reason to consider purchasing UPS stock is its robust free cash flow, enabling strategic investments. Did you know that in 2021 alone, UPS bought back shares worth $500 million? UPS boasts one of the strongest dividend track records available. Recently, its board of directors increased the quarterly cash dividend to $1.62 per share, effective for the first quarter of 2023, marking the 14th consecutive year of dividend growth. While the current 3.5% dividend yield may not be groundbreaking, it's twice the 1.6% yield of the S&P 500, making it highly competitive among other large-cap companies. Adding to this, UPS has greenlit a $5 billion share repurchase program for 2023, along with anticipated dividend payments of $5.4 billion. Moreover, its modest net debt of $11.7 billion against a market cap of $156 billion suggests potential for future dividend expansion. Despite concerns about a possible global economic slowdown affecting earnings projections, UPS remains a robust option, with expected EPS softening in 2023, followed by a rebound in 2024.
Or you name it, Johnson & Johnson. We don't know which of those will come up with a blockbuster commercial drug 3 or 4 years from now, and we don't try to assess it. What we do feel is if we have a group of those companies bought at reasonable prices, that overall pharma will do well, maybe not quite as well as they have in the past.
Taking the third spot is the healthcare titan Johnson & Johnson, a surprising inclusion in Buffett's portfolio. Throughout Berkshire Hathaway's extensive history, healthcare stocks have seldom been a focus. However, J&J remarkably aligns with Warren Buffett's consistent investment strategy. Berkshire has maintained a steadfast commitment to the firm over time, a trend unlikely to waver. Buffett typically invests in companies with significant cash flow that consistently reward shareholders through dividends and share buybacks. Johnson & Johnson not only adopts this approach, but excels at it. Would you believe that they've distributed over 70% of their substantial free cash flows to shareholders in the last 10 years? Moreover, J&J's exceptional streak of over 6 decades of consecutive annual dividend growth speaks volumes. With its established track record, Johnson & Johnson stands out as a preferred blue-chip dividend stock. It serves as a reliable income source for cautious investors, evident in the increasing number of hedge funds holding stakes valued at over $4.5 billion. The sustained demand for pharmaceuticals, medical devices, and services has enabled J&J to grow its adjusted operational earnings annually for 35 years, even through the challenges of the COVID-19 pandemic. This trend is anticipated to persist, positioning the company as an unequivocal buy in 2023, standing apart from its industry peers. At number 2, we have MasterCard, one of the globe's foremost electronic payment companies, securing the second spot on our list. With a market value of $192.7 billion and a modest dividend yield of 0.5%, MasterCard has captured Warren Buffett's interest for all the right reasons. As we know, the Oracle of Omaha has a talent for identifying companies poised for substantial long-term growth, emphasizing the importance of time in favor of outstanding businesses and against mediocre ones. So why did Berkshire Hathaway invest in MasterCard back in 2011? The reason is clear. They recognize the ongoing shift of consumers and businesses from cash and checks to electronic payment methods. Instead of issuing credit cards or extending credit, MasterCard focuses on transaction processing services, earning a percentage from each sales dollar processed across its payment network, while mitigating risks linked to traditional banking activities. Estimates indicate that MasterCard has a market potential to capture payment flows of around $225 trillion, pointing towards significant growth opportunities despite its already dominant position in the industry. Although MasterCard's stock price has demonstrated remarkable growth, with a 96% increase over the past 5 years, its position as a frontrunner in electronic payments solidifies it as a compelling choice for inclusion in any dividend stock portfolio, suitable for both acquisition and long-term retention. In 2011, similar to MasterCard, Berkshire Hathaway identified the immense potential of Visa, a company thriving in the era of escalating digital payments. Visa has encountered substantial growth in payment volume and, astonishingly, there are now more than 3.2 billion Visa-branded cards circulating, a number continuously on the rise. Despite sounding incredible, Visa's extensive reach and efficient use of capital have driven its operating margin to exceed 60%. This financial robustness has empowered Visa to compound its dividends at an impressive rate of over 20% annually for the past 5 years. Forecasts suggest the company's revenue will grow at an average of 10% annually over the next 5 years, and with a low payout ratio hovering near 20%, signs indicate substantial dividend growth ahead. In a world where cash is diminishing, Visa stands poised to benefit from the digital payment revolution. Did you know that a $1,000 investment in Visa a decade ago would now be worth around $5,500 with dividends reinvested? This significantly surpassed the $3,200 that the same investment in the S&P 500 would yield today. For those seeking substantial long-term dividend growth, few companies, if any, offer better prospects than Visa. These factors firmly establish Visa as the top dividend stock on our list.